Well, so I'd like to welcome everybody. The official opening is going to happen at 4:30, but we start the conference without the official open. This is the unofficial part of the conference. Just kidding. So I just wanted to say 2 or 3 words that it's really a pleasure to be back here, and we have been doing this conference for 10 years now. For these 10 years, I think 2 or 3 times we did it really at IMPA. Most of the times it was in the resort. But this is a special occasion because it's the 10th anniversary of this meeting. There are other special occasions that you may find along the day. So I'd like to just invite everybody to enjoy the ambience of Rio. Every once in a while there are going to be announcements such as group picture. I want to make one special announcement for tomorrow evening. We are planning a dinner, a conference dinner at the Terra Brasilis. It's a restaurant, very nice, close to the Sugarloaf Mountain. And what we plan is that we are going to go there, as many people as would like to go, and people who want to go up the hill to visit the Sugarloaf can go, then they can meet us downstairs. For the dinner, it's going to be a dinner that unfortunately we have to pay, and so there's a contribution of 150 reais for that, for those who would like to join. And please sign.
Confirming a theorem that says that there's no free dinner.
There's no free. It's an extension of a theorem. You can claim it's a corollary, a tropical corollary of that. Okay, so I'd like to pass the microphone to my co-organizer. I'd like to very much thank Marco and Bruno for the help, suggestions, and support throughout these years. So since Bruno is the first one to talk, but I'd like to pass them, if Marco would like to say a few words.
Eu vou falar em português, porque eu estou no Brasil e eu estou muito feliz de estar aqui. Muitos anos que eu venho aqui, eu vi falar aqui o ministro de Economia da Argentina antes de um dos estouros que eu vi na Argentina em 2001. E esse lugar, eu vi altas palestras aqui, é uma sala áurea, é uma sala muito importante em termos de ideias. Eu gostaria que a gente também tentasse manter esse nível que tem aqui de ciência e de estar num instituto tão importante como o Instituto IMPA do Brasil, e que sempre foi, né? E é só isso. E eu queria dizer que bem-vindos todos. Eu conheço muita gente, então eu acho que é um prazer ver as caras de sempre e ver que está todo mundo aí na finança, e vamos lá para uma boa conferência.
Obrigado, merci. Thank you, Marco. Bruno, you can say it.
Yeah, just a few words. It's fantastic to be back here after 9 years. So 9 years means 10th edition, as you know. It's not 10 years. But it's fantastic to be here because actually I happened to give an impulse to this thing for the first session in 2006, and after George has been doing a tremendous work. I mean, obviously on the first one as well for the logistics, but after, so he made it possible to repeat it every year in a variety of very nice places, and I really had no clue at the time that what I thought would be a one-off event would actually be perpetuated and would carry on like this. So hopefully we will be able to have a bright future, and so we will count on you to help us for that.
Okay, thank you very much, Bruno. By the way, I'd like to make one small announcement. We have recording and transmission system. So all the talks, not the discussion, but all the talks are going to be, not the round table is not going to be transmitted, I think, but the discussions of the talks and the talks are going to be transmitted. So in case anyone would not like to have the talk transmitted or recorded, just please let us know. I assume that you don't mind, but it's a good idea to ask and mention. So just let us know, or just tell the fellow that please don't record, or it's off the record or something like that. Yet it's of course encouraged that, because Brazil is a very big country, and IMPA has found out that by transmitting such conferences, we really have a very, very big spread of all the information that's going on. And so traveling Brazil is not trivial at all. So it's one way that we have to transmit information very fast. Okay, so without further delay, I'd like to introduce Bruno Dupire. Bruno is head of quantitative research at Bloomberg. He's an enthusiast of math finance. Brazil, and in particular, I can say even IMPA. And so he is going to talk to us about tradable estimates of historical volatility. So thank you very much for being here, Bruno.
Thank you. Thanks a lot for this kind of introduction, George. So I'm going to tell you sort of not really unsuspected uses of volatility estimation, but actually the interesting thing is that it can be used as a sort of trying to reveal some deviations from martingale. And so it can lead to some actually trading strategies. So first of all, you have to know why we're estimating volatility. So volatility is linked to risk. Sometimes we estimate volatility for instance, for asset allocation. It can very often, actually, especially with disassembly, it would be rather probably for option pricing. Volatility estimation will be important because it sort of reflects the cost of the delta hedging of a certain position. But I'm going to show that it's possible to use it also as a trading strategy. So here the outline of the talk, it will be first to show that if in a martingale context, actually the annualized volatility should be independent of the sampling frequency or different stopping times that you're using in practice, it's not the case. It's possible to exploit that. After, I will explain exactly what it is the category of volatility estimates that can be used actually in a trading strategy. So it means if you have two different estimates which are very different, in which cases it's possible to take advantage of this. I will carry on with an estimate based on the high and the low, so which will be tradable. Most of the time, the high-low based estimates are not tradable, and it seems that it's due to the fact that the high and the low are not stopping times. You have to wait the end of the day to know the high and the low over the day, as opposed to a stopping time where you would know the time when it happens. But kind of surprisingly, it's not the reason why those things are not tradable. It's because actually they do not depend quadratically on the final value of the spot price. So I will explain all this. And so I will show an estimate which is based on the high and the low, and still it is tradable. And I will end up with a characterization of tradability. So it's a simple application of the functionality of calculus, so which gives you a criterion to see whether a contingent claim can be attained as a stochastic integral, as a dynamic trading of the stock. So first, here we look at historical data. So it's a S&P 500, the biggest, most traded American index, stock index. So it's a historical volatility computed with daily frequency. So it's the daily closes, and over several years. Actually, I'm going to use the daily closes, but also sampling every second day, third day, and it's what I have here. So here it's the frequency, no, the period actually of the samples. Here it's 1 day, here 5 trading days, it means 1 week. And you see that you have a 25% annualized volatility for the daily samples and something like 21.5 for the weekly samples. And it's quite a substantial difference, and it will be linked to some kind of mean reversion of the stock prices. Just to see whether this is something which is kind of robust. So we go to the different sub-periods, and we'll see that most of the time the difference between the 1 day and the 5 day, the daily estimate and the weekly estimate, is positive. So on different, I will show you this is the biggest one. It's over the year 2008, so covering the crisis. You had a daily historical volatility of 41% and a weekly one of 32%. So in more recent times, it was maybe less salient, so less striking. But how can we take advantage of this difference? So actually, imagine that you're long an option and you have to decide whether to hedge daily or in the slow fashion weekly, which is not recommended because it's too long a time. But still, you consider both. So if you're long the option, if you're in a situation where you have a high daily volatility, higher than the weekly volatility, then you will have an incentive to delta hedge every day to capture with your gamma all those moves. If you were short, you would have you would be tempted to delay a little bit, and because if you observe that the weekly volatility is lesser, so it means that the stock price has a tendency to come back to you, and you lose less when through the gamma. So the interesting thing here is that actually, even if there are no options that are available, you can use those principles to create a trading strategy. You can invent a long position and a short position. You delta hedge the long position daily. You delta hedge the short position weekly. So the option position cancel out. They never existed, actually. And if you net the two delta hedges, you can see that it corresponds actually just to a strategy on the stock price, trying to exploit the intra-week mean reversion. If you use the two variance swaps, it actually corresponds to doing a swap between a daily swap and a weekly swap.
A quick question. When does this signal become trade? I mean, what is it required for this signal to become a trade signal? I mean, go long the daily and short the weekly, or short the weekly and long the daily?
Yeah. So from what we've seen, it seems to be systematically going long the daily and short the weekly. And I will show you in which market conditions it's a kind of robust one. But I think I skipped that. Essentially, the strategy in this case is quite simple. So you observe on the Monday morning the initial price. This will be your reference level for the week. And every time you're below it, you go long the stock. And if you're above, you go short for an amount essentially proportional to how far you are from this reference level. So if you do this daily, and so the next Monday morning, you do it again with the new price of the week after, and you have this new reference point and you carry on. If you do it and if you run the math, you see that actually you will collect all the sum of the squares of the daily returns, and your risk will be the square of the daily of the weekly move. So actually it corresponds to delta hedging a parabolic profile every day, for instance. Yeah. So when does it work? So, actually, here, if you take a 1 year rolling period, so for each start point, actually, you can compute the profit, the P&L of this strategy. And here, so for each start point, it will be a point, for each start date, it will be a point in this graph, where here I have the historical volatility and here the profitability of the trade. So what you see is that you have clearly a positive correlation between the two. So it means for low volatility, it's not very profitable, but for higher volatilities, it is very, very profitable. So actually, the profit and loss will be the square of the weekly estimate minus the square of the daily estimate, and everything is annualized. Another way to look at it, the cross-sectional way. So we did it, the data were on the index itself, but if you do it for each one of the 500 components on a given time period, like here, so you have the P&L here, the profit and strategy, 0 is there, so most of the time it's making money, but not necessarily for each one individually. Here, if we isolate, you can do it with a basket of the most mean reverting. And actually, you see you have some financials like Morgan Stanley here. It's something you can see on this market map representation here. So it's something that is really quite useful for any user. It is to have a compact representation of the market. When you have 500 stocks, if you had a drop-down menu, so you would have to scroll to something like 20 screens. And here, I'm going to show you a representation when you see each one individually. And we'll pay a special attention to the financials here. So here it's a heat map that shows you the profit and loss with a color scale, color code here, for different sectors and each stock in the sector. You see it's the financials mostly were profitable. This one here was the worst case. Actually, it was AIG because it went bankrupt. You can do the same thing with covariation trading. So essentially, we have the same thing from a daily and to weekly. So the mechanics of it in this case, it would be inventing a financial instrument that would give you the product of X and Y, of the price of the two stocks. And if you delta hedge each one separately, then the replication error will depend on this covariation term here. And again, if you do the same thing, you invent a long and a short position. So eventually, you have in a costless fashion, you manage to capture the daily covariation minus the weekly sampled one. So here, to facilitate the analysis, I make my life a bit more comfortable by ignoring all the carry terms, so in interest rates, dividends, repo, and all those dirty things in a math conference. Here, and also another thing is that most of the time I will analyze things in normal terms instead of log normal, or if you want Bachelier conventions as opposed to Black-Scholes, or absolute as opposed to proportional. So that's the case here. So some definitions. I say that an estimate is, I don't take it in a statistical sense too seriously, but I would say that an estimate, or it could be actually a contingent claim, it's tradable from options if you can write it as, so in this case, as a certain function of the final maturity. And as you know, such a function can be written as a portfolio of options of different strikes, plus what I call stock trading, which is a stochastic integral with respect to the stock price, so dynamic trading of the stock. Second definition here, I would say that it's unbiased so it's an unbiased estimate of the historical volatility seen in continuous time as the quadratic variation. So if for all martingales, so the expected value of the estimate is the one of the quadratic version. Actually, I should have a square bracket here because it would hold as well if you have jumps. And this, we know that for a martingale, so it's also actually the variance of the process here. So you can see easily that if you have an estimate which is both tradable and unbiased, it means that this option position here will have to be this parabola plus a linear component. It's due to the fact that if you subtract the parabola here, so the condition becomes that you need to have a function of x which has 0 expectation under all martingale measure, and you can show that it's only the linear ones. If it's not linear, you can create a binomial martingale, which would violate that. So eventually it means that as this linear guy is part of the trading strategy, an estimate will be tradable and unbiased if and only if it is a parabolic profile plus some stochastic integral with respect to the spot price. And one of the important things is that it has to depend quadratically on the final value, which will not be the case with the high-low based estimates we've seen before. So very interesting, the most interesting probably class of this tradable and biased estimates. It will be given by discretized quadratic variation. So which is, so if you have a sequence of increasing stopping time, so increasing, and you compute, so still it's everything in the absolute and not proportional conventions. But so if you compute the sum of the squares of the price differences between those stopping times, so let's call it discretized quadratic variation, then we'll see that this is it is a tradable and unbiased estimate. It's due to this algebraic equality here that this sum of the squares can be seen as, it can be written like this as well, which, by the way, corresponds to the delta hedge of a parabolic profile that you delta hedge at those stopping times. So this is the change of value between the tau I and the tau I minus 1. Tau I minus 1 and tau I. So you compute at tau I minus 1 the delta, which is 2 times this. And this is the position you take and the change of value of it. So it's the number of stocks you have times the price change, which is this. So now something now very interesting, it is the fact that if you have two such estimates, so two different stopping times here, actually you can look at one minus the other one. So if I have a sequence tau and another one tau prime here, if I look at the difference, so that was I look first at the difference of the left-hand side, so it's this quantity that you can observe. For instance, from what you've seen before, it was the daily vol minus the weekly volatility. And then you look at the difference of the right-hand sides. So the parabolic payoff will disappear. As I said, the option position is not there anymore. And you get actually this, this is the net delta hedge. So this is a stock trading strategy. So it can be seen as a stochastic integral. So actually you would change your holdings at this good point in time. And so here it tells you that in a costless way, because this right-hand side is costless, it's self-financing from zero initial wealth, you can create a quantity which is a difference between those two discretized quadratic variations. So the classical close daily estimate is obviously part of this category, of this class, because it corresponds to deterministic stopping times, which is just the end of the day, every day. You could have done something else. So the classical one is time-based. It's every time that a certain amount of time has elapsed. So you take a sample. It could have been also move-based, so which is you can create a sequence of stopping times which correspond to, after having defined different horizontal levels, price levels here, you always keep track of the last time, every time you cross one of those levels that is different from the last one you crossed, then you record a new time here. So this can be used, yeah. If you remember, I had presented similar things, Chris, at your conference, I think in Cambridge in 2005, and I said, oh yeah, I have a new result, which is that the number of crossings in continuous time actually gives you a very sharp estimate of the volatility. Do you know if it's well known or not? And you looked at it and you say, I don't know whether it's well known, but it's trivial. It's obvious. I remember. So actually this, sorry? Yeah.
Result of me in Asterix in 2000.
Asterix. Yeah. Yeah. So the interesting thing with this approach, it is that actually if you estimate volatility like this by the number of cross points, so actually in practice, if you do with discrete data, so you will not manage to capture, I mean, prices are discontinuous. So obviously you have to take the precise time when you have observed you went over the thing and keep those times to compute the sum of the square of the price differences. So you have to account for the overshoots, obviously. This estimate actually is a very interesting one in terms of option pricing and hedging, because it is, in some sense, optimal in the class of, okay, if you try to investigate in the class of different hedging strategies, what is the best one, imposing some constraints. So what I had done, it was, again, in a very simplified world, so Bachelier, so no drift and absolute things. And there was an option which has a constant gamma, a parabolic profile. If you impose a condition which is the expected time during two rehedges, then you can prove that the optimal one is the move-based one. So actually, in general, you should rehedge when the delta and your net exposure is reaching a certain level. And so in the case of parabolic profile, it's a constant gamma, and so it means when the stock price has moved by a certain amount. If you're in a region with a higher gamma, then you should do it more often, because it would be a smaller price move that would trigger the same difference in delta. So it's a whole class of different estimates as well, and you can trade them between themselves, or you can trade the move-based against the time-based. Just a word, you have to be, whether it be with time or space, you should take an average over the phase. So, okay, let me give you an example. For the weekly estimate, so you may compute it from Monday to Monday, or it could have been from Thursday to Thursday. You may have quite different results just by chance, and so to smooth it out, it's better to take an average over the 5 possible starting dates. Same thing, and especially more probably with this move-based. You should compute it, making an average on different starting points. So you have a spacing between the levels, but you should average on different starting things. Because here, for instance, here it's a spacing. So I had a frequency gram before when you had the 1 day, 2 days, and all this. Here it's a spacing between the levels. And here it's when you do it without averaging, so it goes all over the place. If you average over the phase, the start points, you have this red one, which is much more usable. So now the high-low estimates. So it's this classical representation of candles here. So over 1 day, so this will be the high, the low, and it's green if it went up. So it means it opened here and closed there. And when it's red, it means it went down. So it means that it started here, ended there, and in between, this was a high and a low. You don't know which ones was attained first, but you have something much more that contains a lot of information compared to just the the open and the close, because obviously the high and the low aggregate a whole behavior during the whole day. And just to give you an example, if you try to estimate the average price over the day, actually, it will be better to do it by taking the average of the high and the low than the average of the open and the close. So classical estimates, so you have the Parkinson estimate. So typically you would see high minus low. So this means it's called the range of the process. So as obviously a reflection of the activity of the day, of the vol of the day. So you have also Garman class. You have Roger Satcher, nothing to do with Chris. No, it is his. So Chris Rogers and Weaver Satcher. So which unfortunately I think is not tradable, yeah, but close to. So yeah, you have plenty of different ones. So again, the great thing is that they capture more information of the intraday activity, but the question will be, if I find a daily estimate of 20% and a high-low based of 30%, how can I take advantage of it or not? The answer is no, not really, because those estimates are not tradable. But first, those estimates which are based just on the high and the low, so it captures the daily activity during the trading hours, from typically in the States from 9:30 a.m. to 4 p.m. But to make it comparable with an estimate which is, for instance, from close to close, which is covering all periods, you have to add up the night activity, so which is the uncertainty of the night here. So here on the S&P 500, for instance, and this was during the crisis, here it is the variance during the Monday trading day. Here it's the night from Monday to Tuesday, and so on. So days and nights, and here it's the weekend. And it's a confirmation of the fact that actually many traders know pretty well, which is that the weekend is not really different from another night, even if it's much longer in calendar day, in calendar time. Here it's Goldman Sachs. So we have the same kind of things, except that you have more night activity. So it's just to make estimates comparable, you have to systematically add up the contributions of the night uncertainty, the quadratic variation, for all the nights. So the big problem is that actually all those high-low base estimates are values you can compute, but you cannot really directly trade out of them because there is no trading strategy associated with them that would allow you to monetize the difference between two estimates. It seems that it's due to the fact that it's always observed after the fact. And so it means you say, oh, I should have traded at this level, but it's too late. So it's not stopping times. But surprisingly, no, it's because they do not depend in a quadratic way on the final spot price or the end of day price. But here I'm going to introduce an estimate which is actually based on the high-low, but it is tradable. So it's due. It's something I looked at just by chance, actually, in the 90s. It was to analyze a popular trading strategy, which is called averaging down. So it's just a spot trading strategy without any option. So just investors often they do this. So basically, if they think that something might drop but should bounce back, so they buy more and more when it goes down, when it beats a record, the minimum. So if you do it, so it means you will buy more and more every time it goes down, and to see the profit, the wealth generated by this strategy, actually, we're going to look at how much it costs and how much you get. So at time t, so if you buy a little bit more, so up to some multiplicative constant, but at time t, so small mt is the running minimum, and so you've bought this amount of stocks here, and if you assume continuous prices, so you will have bought at each intermediate levels between S0 and M. So your average unit price will be S0 plus MT divided by 2. So this makes the computation of the wealth generated by this easy. So the P&L is the value of your position minus the cost of it, the value, so you have this number of stocks. The current value is ST, so this amount of dollars here, and minus the cost of creating the position. So it was this number of stocks with an average price here. And so when you rearrange things, you're able to write it like this, as that's called it's not the drawdown, it would be the draw up, actually. The current spot price minus the running minimum squared minus the return squared, and divided by 2. So here it means that from zero initial wealth, you're able to construct to produce this quantity here. So this means that expectation of this guy under any martingale measure, so we just assume continuity here, so it will be 0. So in other words, it means that for a continuous martingale, we have this interesting equality here. Expectation of the, so the draw up squared is actually the variance of the process. If your martingale is not continuous, when you have some possible drops, so it means that the average price will not be what we've seen. You will have some gaps, and actually it will make it cheaper. And so what you get is still an inequality. This is lesser than that. So if it jumps up, so it's not contributing to beating the minimum, so it's irrelevant. So it would be only if you have a jump down that it means you beat the current minimum and you land immediately at a level below here. So it tells you, notably, that actually this would be actually the price of a look-back option. It's lesser than the standard deviation. So that's the best thing you can do if actually you have, let's say, for instance, parabolic profiles being traded, because you would know the market price of it. If you know more than this, people like David Hobson and probably Chris have been looking at refinements of this. So, so essentially, what we had here, if you write it in the language of the high, low, open, close, so it's the expectation of the close minus low squared. This is the expectation of the close minus open squared. And yes, so here I can look at the symmetric version of it, and eventually I can get two estimates, and it's better, it's more comforting to have a symmetric version of it. So actually, the estimate will be this quantity here. So you can check that it depends. It's tradable because it's the only thing that I've been doing. It was with trading the stock dynamically, and you can check that it depends quadratically on the final stock price here. So what you can do as well, it is to look at the difference between those two estimates. So you manipulate a bit, and you find it's the square of the range times something that tells you where the final price is within the attained range, the high and the low. So what does it mean? If ever you observe that a stock price tends to end up every day pretty much on the upper half of the range, then you can monetize it with this kind of strategies. Here it's a comparison of different estimates. So the blue is the historical, so the daily based, and you have different ones. They are all corrected for the night effect. And so the new one here, the magenta one, is the highest. So actually it shows that it's not so different from the usual high-low estimates, but it is tradable. So in some sense, it means that high-low estimates are close to tradable, and the way to do it is through the strategies I've spelled out. So now I'm finishing with a characterization of tradability. For instance, if we take a high-low based estimate, we say, how can I show? Yeah, imagine you have a high-low estimate which does depend quadratically on the final spot price. Do we have a criterion to know whether it is really tradable? Or more generally, so and the criterion will be that it should be the quadratic, the square of the total return plus a trading strategy, self-financing trading strategy of the stock. So what you have to do is to subtract actually this parabolic stuff, and the question now becomes, when you have when you have a contingent claim, do we have a criterion to say whether it's achievable, it's attainable from zero wealth and just trading strategy of the dynamic trading of the stock. So it's a nice application of the functional calculus I developed in the 2008 and 9. So for the people who don't know it, so essentially, as opposed to looking at how, like in the Ito's lemma, for instance, at how the function of the process is changing when the process itself, the value of the process is changing. Here, it's a function of the history of the process to see how it changes when the current path is changing. So it means you cannot change what has happened. You're not necessarily making any assumption about the future. Just look at what happens when you're functional, when you apply your functional to the new path. So here I consider two. If I have a current path which is a white one, so I consider two possible perturbations. So one is an instantaneous bump in the price. This will correspond to the notion of a delta for a trader. So you look at the new value minus the old one divided by the bump to take the limit, and the other one that will correspond to a theta. It is what happens to your functional when you extend the current process at its current value. Here it was different examples, simple examples of functionals and their derivatives. But for instance, if you have an integral with respect to time. So when you change the current value, it's not affecting the integral, so the derivative is zero. If you extend in a flat way, the integral will increase by the current value times dt, and eventually you find the current value. And if you have a stochastic integral, actually, so when you change the current value, you get the integrand at t minus, and if you extend in a flat way, you don't get anything. So this will be something we are using here. So it's a claim is attainable from just by trading the stock. So it will be if and only if actually the second derivative, price derivative of a certain functional is zero, and the first derivative of it will give you the integrand. So the trading recipe, the holding is at every point in time. So if I have, let's say, G in this case would be the final contingent claim. It can be the term sheet of a financial contract, for instance. So you create a functional that applies to any intermediate, the current path before you reach maturity. So here, this path here. So you look at what happens to the value of the contract if the price was stuck at the current price. So this is, so I induce from the term sheet here, from the financial contract, the final functional, running functional if you want here. And so the result is that this, this contract will be, so it should be a cap T here, it will be a stochastic integral plus a constant if you want. If and only if the second derivative is 0 and the integrand will be given by the first one. So the proof is simple. So it means if you have something which is a constant plus a stochastic integral, then when you compute f of xt by putting it to 0, so you keep the stochastic integral so far, and between small t and cap t it's 0. So you have this, and now when you compute the derivatives here, the first one will give you the beta t minus, and the second one will be 0. It expresses the sort of a local linear behavior of a stochastic integral. So you have it corresponds to a certain number of holdings of the stock, and if you bump the stock price, it just affects your position linearly because it's not affecting the current holdings, because the holdings are beta t minus. Yeah. The converse way, so if you apply the functionality formula to the functional, so you get all those terms, classical terms with different interpretation. Yes, and we have a couple of terms that will disappear. So if we assume that this is 0, this goes away, and by the nature of f, the way we've constructed f, this is 0 as well. So eventually we just get that. So it means that if those conditions are satisfied, then it was a contingent claim. But I think I have to stop now. I just had examples to show how applying this recipe to different claims, you can find either the decomposition here or to prove it's not possible. And the end, it was reviewing the discretized quadratic variation and the new estimate to show that they are attainable. So I stop here. Thank you.
Sorry, Bruno, for enforcing our time constraints. Sure. We are going to skip the questions for now. I'd like to mention that on Wednesday we have time for discussions also during the lunch time, so people can grab Bruno and ask for the details of this. But we also, after Marco's talk, then we'll have questions for both speakers. In fact, this is the kind of system we have been using at Rio. It's kind of trademark now that we have a panel type discussion, and so the questions could be addressed both to Marco and to Bruno afterwards. So without further delay, I'd like now to introduce Professor Marco Avejaneda. Can we put his presentation? Marco. He's going to give you the